inflation, taxes, crazy markets. Join us this week as we talk about how to create layers of protection in your retirement so that no matter what happens in the world, it won't affect your lifestyle.
Welcome to Label on Fire with Label Sternbach, the financial independence and retirement show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. Ladies and gentlemen, it's time for Label on Fire.
Hi, everyone, and thank you for joining us for Label on Fire. Joining us is Label Sternbach. He is an enrolled agent with the IRS, a national Social Security advisor, a financial consultant, a CFP but better, and a portfolio advisor from the Colleges of Financial Planning and Financial Services. He's the author of 2 different books entitled Living with Financial Anxiety and Authenticity. Label, hello, and welcome back to the show.
Hey, how are you doing today?
Unbelievable. And I'm really curious about today because we're talking about inflation. We're talking about taxes. We're talking about crazy markets so much. So I'm wondering, is there some kind of magic bullet Label? What's the secret? What do we do?
I really wish there was a magic bullet because it would make my life so much easier. I speak to investors day in, day out, and all of them, they ask all their different questions, but at the end of the day, they're looking for that magic answer, that magic bullet. And they're very disappointed when I tell them that really the only magic bullet is to have a good process in place. You need to have a process in place for making financial decisions, because if you don't have that process in place, then you're just guessing, you're just gambling. And they're like, but Label, what should I do? What should I invest in? What should I buy? And it's everyone is different. And the answer for one person is different for a different person. But the fundamentals, right? The fundamentals, we need to make sure that the fundamentals are covered, and the fundamentals are the same for everyone. It's just a matter of what proportion and where you are in your stage of life.
So are the fundamentals the secret sauce to all of this?
I think so. I think the fundamentals are really the secret sauce, right? I'm not a big fan of Dave Ramsey, but if you look at him, he is always saying the same thing over and over again. And there's a reason for that, right? It's the fundamentals are what are going to protect you. And you just need to be savvy enough to be able to figure out how to apply it to the different situations. For instance, it doesn't take much to look around and see all these articles that are saying the 60-40 portfolio is dead, things like that. The bond market, fixed income, interest-bearing investments, they have changed fundamentally in a way that they haven't changed in over 20 years because interest rates have changed. So applying the concept of I want to have investments that don't fluctuate a lot that I'm going to live off of, that requires looking at your investments and saying, is the way I'm invested, is it for today or is it for yesterday? Is it for the future or is it for the past? Because what worked the last 20 years is not going to be what's going to work for the next few years, as a lot of people have found out that their moderate portfolios were actually super aggressive in terms of the type of losses they had. And now that they're going to the recovery, they're not recovering as much because the truth that held up for the last 20 years is not the truth that's going to be for the next 20 years. And so you need to have that process of being able to identify when these changes happen, these fundamental changes happen, and what to do about them.
We've seen in the last several months, maybe a year or so now, the interest rates creeping up to get inflation back in control. And I think a lot of individuals, their most direct relationship with inflation would be at the grocery store. They can see the different higher prices with grocery. So how do we protect our money, I should say, Label, from skyrocketing inflation? It's a 3-part question. We'll start first with skyrocketing inflation.
All right. So how do we protect ourselves from inflation? And so you have your decision-making process, and you got to create these layers of insulation between you and whatever is hurting you, right? So that if it gets through that first layer of protection, you still have a second layer. And if it gets through that second layer, you still got a third layer. And even if it gets through that third layer, you have time to react. And that's the biggest thing, is giving yourself the time and the flexibility to be able to decide what to do on your terms rather than the market's terms, rather than the Fed's terms, rather than Congress's terms. Because if you're operating on on someone else's timeline, chances are you're going to make the wrong decision, right? Very few of us are wired to be able to make intensely right decisions under extreme amounts of pressure. And so we need to build that layer of protection into whatever we do. Now let's talk about inflation, right? There's only one way to protect against inflation. And you might think I need to have a CD, I need to have something that returns interest. And here is a little secret for you. You will never get from the bank enough money to protect against inflation. Okay, they will always pay you less than what inflation is. And that's because they need to make money, right? So the only way to protect against inflation is to take on some sort of equity risk. You either need to take on excessive debt risk or you need to take on some form of equity risk. You need something that pays more than the current rate of inflation. And the bank generally doesn't pay more than the current rate of inflation because that's how they make their money. You got to invest some in the stock market. There's no two ways about that. The stock market or the bond market, which has the part of the bond market that has as much risk as the stock market.
Very interesting. So that's part one, skyrocketing inflation. How do we protect our money from that? And how about protecting our cash from higher taxes later?
So higher taxes, this becomes a little more tricky, right? Because now we got to look into our crystal ball and we got to say, what is taxes going to be in the future? And here's the thing, right? People come to me all the time, and I even talk about it in my webinars, I talk about it in my videos and my writing, right? We try to project to the future what taxes will be, but we don't know what taxes will be. Right? We don't know what's going to happen. We don't know what actually will get passed in Congress. We don't know what they're going to try to make happen, what's going to get extended, what's going to get shrunk. So what we need to do is we need to create that layers of protection, right? That multi-step plan so that if A happens, if the worst case happens, we know what we're going to do about it. If the best case scenario happens, we're protected, right? And if something along the middle happens, we know what our choices are. So let's take an example for taxes. A lot of people are thinking Roth conversions right now. They're like, market's down or it has been down. My portfolio is still recovering. Should I do Roth conversions this year? Should I take advantage of the fact that we have historically low tax rates, and we know in 2026 that the Tax Cut and Jobs Act is going to expire. So Congress is going to have to do something, and chances are the tax brackets are going to change. The tax code is going to change. So people are asking themselves that question: should I take advantage of the current tax climate? And here's the thing, right? The answer is different for every single person. I have yet to give the same answer to two people, and that's because it really depends on your situation. How badly would you be affected by a worst case scenario of tax rates going up significantly? How much of an advantage will it be to you if you took advantage of current tax rates? And ultimately, the question is, how will it impact your lifestyle? I met with a gentleman the other week, and he was talking to me about taxes, what to save on taxes. And I'm like, dude, you've got more money than you know what to do with. You're not going to need any of this. So what is your motivation for saving on taxes? Is it just that you don't want to pay taxes, or is there some other reason behind this? And let's address that actual reason, right? Is it that you want to give as much money to your beneficiaries? Is it that you want to donate it somewhere? Is it you want to use it in your lifetime? Those aren't pay the least amount of taxes reasons. Those are things that you want to use your money with. So you need to ask that question first of what is the purpose of your money? And then you figure out, okay, how do I make that happen as effectively as possible? And sometimes that means reducing your taxes now. Sometimes it means reducing your taxes in the future. And generally it's somewhere in between where you take on some of that. Okay, I think there's a 20% probability that I'm going to be paying higher taxes. So let's take appropriate actions where maybe I'll be wrong, but I won't be catastrophically wrong. So you got to have those layers. And the truth is that you need to be ready to take action. The closer we get to when that deadline happens, when Congress is going to take action, you need to be ready to take action. You need to know, okay, if in the news Congress is talking about increasing tax rates, I am going to convert this amount of money, right? I'm going to have this ready to go. And you need to have that plan in place. Otherwise, you're just exchanging a potential disaster for an actual disaster.
So how do credit cards fit into these layers of protection that you just mentioned a few seconds ago?
So credit cards, and really short-term loans that you can take out provide a serious amount of insulation, right? And this can come in the form of an emergency fund. It can come in the form of a credit card. It can come in the form of a securities loan. And a securities loan is something that most people are not familiar with. It's like the concept of when you have a 401k and you borrow money from your 401k. In your non-retirement accounts, you can do the same thing against your investments, and you can actually do it at generally a better interest rates than what you would get from your 401k. Now, what does that do? That means that if there's an emergency, right? Let's say the stock market is still down and you need to pay for your living expenses, or you need to take money out for that required minimum distribution, but you don't want to lock in the losses of the market, right? Because you're a savvy investor and you know that locking in those losses in the market is going to hurt you in the long run, right? Not only are you going to lock it in, but you're going to compound your losses. And so you know that whatever you have to do, you have to let that money recover. But at the same time, you need money either for that required minimum distribution or whatever it is, right? So in order to satisfy those needs, you can get whether it's you dip into your emergency fund or you use a credit card or you use a security loan. And really, a credit card would be the last in that list unless you have a zero interest credit card. But you want to have something that gives you that ability to bridge that time period from where your investments are today to when you know they're going to recover. It's going to recover. We know the stock market is going to recover at some point. It's a very high likelihood of that happening because of inflation. As inflation happens every single year, it means that everything becomes devalued, which means prices increase, which means that naturally the price of stocks, right, as a whole need to increase. So if we're positioned properly, we'll participate in that. So getting credit card, having some sort of loan to bridge that gap is extremely beneficial. Of course, you got to weigh the pros and cons of how much you're paying in interest, but you also got to weigh the short-term interest versus long-term locking in losses, right? And so that's why I build into every single plan that I build for people is we have layers of protection where okay, this is the money I'm living off of. This is the money that I'm going to live off of in 2 or 3 years. And if the market is down in 2 or 3 years, this is the money that we're going to be using to live off of so that we never have to take our long-term investment. So we never have to hurt our long-term financial success.
What you've just outlined, are these steps that our listeners can follow to have a more secure retirement plan?
Yes, absolutely. So on our website, there's something that I call the 321 retirement plan. And I outline step by step how to go through and implement this in your life. I talk about how we do it for our clients, but anyone can do this. And it's all about creating those layers of protection, that diversification, right? And that's really what the 321 comes from, 3 layers of protection, having that diversification so that even if one part of the market goes down, you have something to counteract that. So I walk through that step by step on the website. Look for the 321 retirement plan. Just go ahead and download that step-by-step instructions. If you have any questions, just shoot us an email. We're more than happy to help.
So we just go to yields4u.com and get that information?
You got it.
That's yields4u, yields, the number 4, the letter U.com, and get that information. Label, that's about all the time we have for today. Join us again next week, everyone, as we talk about which accounts to spend down first in retirement on Label on Fire.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yields4u.com. That's yields4u.com. Or call 410-914-4894. That's 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.